Well, we have reached the last part of a series of presentations. In the first three parts, really, I try to show you that you cannot believe anyone. And in fact, if you cannot believe anyone because no one is 100% right, then you cannot even believe yourself. Because yes, it gives you some comfort of believing what you believe is the right thing, but you know that you don't have 100% batting average. So even you don't know when, but you will be wrong. So what I'm showing is that through a disciplined approach, by looking at the business cycle, which asset classes you should choose, how you minimize volatility, you can manage your portfolio and protect it from devastating events. In this section, I will show you exactly what I follow, the strategy and the tactics to manage my money. Again, the main objective is, as we said, is not to make returns, is not to maximize returns, but actually, if you want to protect your portfolio against the unusual, devastating events, you have to manage risk. And you manage risk but by reducing portfolio volatility through the process that we have discussed in the previous parts of this series of presentations. In this part, I am going to discuss a hedging strategy that I'm using to manage my portfolio. Again, the hedging strategy is to protect your portfolio. And you have to protect it in a way that if the market goes down, the investments that you make to hedge the other part of the portfolio protect your portfolio on the downside. Let me show you how. It's a very disciplined approach. That's why I said you forget about everything you read on the newspapers, you listen on TV, and so on. This is a very specific, focused strategy. The objective of the hedge is to protect the portfolio from losses. The job is easier if the portfolio to be hedged has low volatility. That's why we've been always emphasizing minimizing risk by using low volatility investments. That's the only way you can make money and, on the other hand, protect your portfolio on the downside, at least in my humble view. Let's start with a very important and simple relationship. This graph shows the stock market, the blue line. As you can see, the blue line, here it is, and here it is, and with all these fluctuations going to moving to new highs in 2013. And the green and red line are bond yields. And bond yields, as you can see, they mirror quite closely the ups and downs of the stock market. Just don't try to read too much into it, because we're going to go really into detail with this information. And this is corporate bonds, and you can see corporate bonds is a little riskier than treasury bonds, so the yield is a little higher. But the turning points are exactly the same as the stock market. In other words, the basic thing you have to get out of this, come out from this chart, is a turning point in yields always approximate the turning points in the stock market, especially in the very near term. Another important thing that, people when talk bonds, I manage $3 billion worth of bonds, so I think I understand them. And one of the things that I sense when you talk bonds, people always think about income. No, you invest in bonds for capital gains. If you're buying bonds at the right time, you make money. And in fact, more often than not, you make good money. But the capital gains on the bonds depend on maturity and quality. In other words, if the bond is long term, the price will fluctuate the most, and the quality will allow you. The higher is the quality, the lower is the fluctuations. So what we will focus is investment grade corporate bonds, which have a pretty long maturity, which means above 7, 8, 10 years, and then of good quality, investment grade. Let's go back and revisit the relationship between yields and stocks, but this time I flipped them upside down. Instead of bond yields, I look at bond prices because that's the best way to look at it. And this is the way over 3 to 4 months how the stock market, let's say, idealized ups and downs. By the way, the same thing applies over a business cycle, but you got to read my book to get into that. This is, let's assume, is a 3 to 4 months cycle. What happens is that and these are bond prices. See, these are bond prices. Now, what happens is that when the market rises, after it bottomed, after a few, let's say, weeks or days, the bond market peaks. The way you can rationalize that is because bond investors are realizing that this bottom is for real. So what they do, they sell bonds and bond prices decline, and they invest in the stock market, and the stocks rise. There is a point, however, that the same investor realize that the stock market went too far too fast. So what they do, they start selling stocks and they start buying bonds. And the bond market start rallying and strengthens. On the other hand, eventually there is so much selling that the stock market peaks and declines. So you have a point where the bond market, bonds rise and stocks decline. But there is a point where people start buying stocks and the stock market bottoms, like in this case. So the bond investor realize that this is a solid bottom. They start selling bonds and buying stocks. So as you can see, I guess where the interesting part of the relationship is this one, that when the bond market declines, stocks rise, but when the stocks market decline, bond prices rise. So you see the hedging strategy. The hedging strategy is by, if you feel, or your measures, indicators that I will discuss, tell you that the stock market is in danger, you should increase your bond exposure so that you make money with bonds and you offset the losses of the stock market. This is the basic model that I am proposing. Let me give you more details. This is the LQD, is an excellent ETF, and is the investment grade corporate bonds. This is what I use in my portfolio to hedge. The important thing of this chart is that the market the market bottomed in November of 2012 and went up, straight up. But look what happened to the bond market. The bond market declined. So the bond market was telling you that the rise in the stock price, if you refer to the previous chart that I showed you, it was for real. Bond investors were selling and buying stocks. Then here the bond market strengthened, and in a way this could be considered as a warning that there could be a top in the market at some point in the future. You have, how do you get a sense of the direction of the market? What I use is what is called stock charts extensively, what is called a slope. And the slope tells you what the curve above, what the price is doing. As you can see, when it goes down, it tells you it's weak, and here it tells you it's strengthening. The slope is trading this indicator, if it declines or rises, is a very effective tool of management. It takes you very close attention, and you can, the parameters of the slope, you can adjust them to come up with this curve the way you like it. If you want to follow these turns or you want to start the basic turns, in this case I changed the numbers so that I follow the big turning points, because that's what I'm interested in. This is the full stochastic. It gives you a little more the near-term turning point, but I look at it more as information than anything else. I really like to follow this basic curve. But again, the point of this graph is that the bond market is an example where the bond prices decline as the market in November, here in November, kept on going up. J&K is a high yield. He's a high yield bond ETF. And the JNK is very closely related to the stock market. In fact, the way I use JNK is to invest in the S&P 500. But the interesting thing about JNK is that it has much less volatility than the stock market, so it's easier to follow with the statistical measures that I showed you before. But what I also use is LQD, the ratio between JNK and LQD. The ratio of JNK and LQD gives you the relative strength of JNK relative to LQD. So in this case, the ratio went up, telling me that JNK was stronger than LQD. In other words, the stock market, remember, JNK is closely correlated to the stock market. The stock market is stronger than the bond market. So you should be more in stocks than bonds. Again, remember that I'm using this hedging model, stocks, bonds. Then here the ratio started declining, so that told me that LQD was getting stronger than JNK. That means LQD was getting stronger than the market. So shifting money from LQD to the market, from the market to LQD, or from stocks to LQD, was the right way to do it. And you can see this keeps on going. You can put under it some graphs like this, or the slope, and it tells you that this is where LQD is getting stronger than the market. Here LQD is weaker than the market. Here LQD is weaker than the market. Here LQD is stronger than the market, because the ratio declines and the indicator measures this declining with much less volatility. So this is all tools, very mechanical, but as I said, it gets you away from thinking what Bernanke is doing, what the Wall Street Journal is saying, or CNBC or Bloomberg. This is a very disciplined approach. And again, moving money from LQD to the market to hedge your portfolio, not based on news, but based on how the market are acting. This is another, again, these are all ideas that I'm trying to give you by using tools that are very useful understanding. They're not right all the time, but the chances are they always put you, well, always is a difficult word to use, but more often than not, the overwhelming times, let's put it this way, put you on the right side of the market. Maybe sometimes you don't have that, make that much money, but if nothing else, you're playing it safe. Again, this is the graph of the stock market, and this is again another example of slope. I like that indicator. Why? Because if you find the right parameter, you have to finagle a little bit to find the right parameters, but it gives you, when it declines nice and smooth, you know that the market is likely to stay weak and the bond market strong. Then here it rises, so it tells you the stock market is going to be strong and therefore the bond market weak. So you have this gradual transfer from the bond market to stock market. Here it started going down, so you have to start now transferring a little bit of money from stocks to bonds. Here we started again, here again, and the process continues. So this is a very disciplined approach. This indicator in stock charts is called slope. So how do you structure your portfolio to protect it from devastating events? First of all, you have two sections in the portfolio. The first section is equity oriented. You have low volatility stocks, and the low volatility stocks have to reflect what kind of economy you have. If you have a weak economy or a strong economy. And I made a presentation, I gave you what kind of sectors best fit this classification. Then you have possibly find those stocks that have rising relative strength. There are programs to allow you can compute, you can use stock charts to compare stocks and select the ones that perform better. The rising relative strength stocks have an advantage more often than not, that they rise more than the market, and when they decline less than the market. But anyway, the point the basic point is low volatility stocks with rising relative strength that is stronger than the market. The second section of the portfolio is bonds. I put J and K here, but really this should belong more to the stocks because it's sensitive to the stock market, and LQD. And obviously, if like in 2000, beginning 2009, with the economy very weak, bonds have performed very, very well. But again, this bond allocation and the allocation of bonds, the allocation of stocks, it depends on those indicators. So if you see that those indicators are declining, maybe you should add to bonds. If the indicators are rising, telling you the market is stronger, you should buy more stocks. But this is the basic structure of the portfolio. The question is, how do you execute that? I found gradualism is the best way to do it. When you see some, because the mistakes are not big, and you slowly move into the right direction. So set up, depending on if you do this strategy over a day, a week, a month, but always move in small amount relative to the portfolio so that you follow and you really follow those lines, the action of the markets very slowly. And you, again, this is basically done because in this way you don't make mistakes, big mistakes. So what is the point of part 6 and basically of the whole series of presentations, and is use investment grade bonds to hedge low volatility stocks. That's the basic concept. Follow indicators to change how much you allocate to bonds. I showed you slope is probably one of the best ones that I follow because it's the smoothest one. Remember that in a weak economy, bonds perform well. Don't worry about what people are saying, but if the economy is weak and it's growing very slowly, bonds are produce very attractive profits. In a strong economy, on the other hand, bonds perform poorly. So in a strong economy, you should use less bonds. Use J and K to reduce the volatility in a rising market. Why? Because J and K acts like the stock market, although it's a high yield bonds, acts like the stock market, but with much lower volatility because of the high yield that you earn at the end of the month, around the 11th of each month. Well, I want to thank you very much for following this series of presentations. I hope you found them useful, and hopefully I'll see you again really soon as subscribers to our service. Again, thank you very, very much, and see you soon. Take care. Bye-bye.